From the morning reading, markets drift as biotechs gain. Apple reports, FOMC to report Wednesday at 2 p.m. Eastern Time. XLV, XLP, XLU were the strongest sectors, while XLE was the weakest sector. Breadth weakened on the New York Stock Exchange as decliners led advancers 2.85 to 1, and on the New York Stock Exchange 2.44 to 1 on the NASDAQ. SPY pulled back on below average volume for a second day ahead of the FOMC announcement on Wednesday at 2 p.m. Eastern Time, forming a bull flag pattern. Diamond is also in the second day of a bull flag pattern, while IWM pulled back from resistance in a sideways trading range. Apple barely moves in after hours after an earnings beat. The NASDAQ 100 Trust, QQQ, rose on Tuesday, while the Russell 2000 IWM lost more than 1%. Of the 30 other times this has occurred, a week later, QQQ was higher only 27% of the time, averaging minus 1.3%. IWM was higher 40% of the time, averaging minus 0.6%. IWM outperformed QQQ 58% of the time, averaging an outperformance of plus 0.7%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:43 a.m. Central Time, and I'm recording this in preparation for the market day of October the 28th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive into our overnight action. In the morning report, we show slight bullishness, and in some cases just above scratch. The S&P futures are up 4 points for less than 0.1%. The Russell's up 0.29%, the NASDAQ's up 0.3%, and the YM, sort of like the S&Ps, is just above scratch. Crude oil had a big overnight move, up 1.13%. Euro up about 0.25%, bonds down about 0.25%, and gold at the time of this cut was up about 0.2%. In overseas action, Asia mixed. China down about 1.7%, Hong Kong down about 0.8%, but Japan up about 0.7%. Germany and the United Kingdom both strongly up. Germany up about 0.6 and United Kingdom up about 0.4. In terms of macroeconomic reports for today, you have the usual Wednesday crude oil inventory. You also have good trades balance before the market opens. And then the big one, the FOMC statement at 2 o'clock this afternoon Eastern Time. With that, of course, will be the Fed funds rate, and that will be a major mover of the market. It should say it could be potentially a major mover. Obviously, if things come right in as expected and no new news is divulged to move the expectations, then the market could just go sideways. But there will likely be some response, even if it's as expected, as just the relief that there is no new information is news in itself. So anyhow, expect that the markets could potentially, especially after the first hour after the cash open, be relatively quiet, choppy, sideways market going into the FOMC announcement. And then once you get that announcement, understand that you won't know the true market reaction for some time. And I remind you of the last FOMC announcement. Let's go to our SPX. And notice this big upper wick here. Well, that was basically the price action of the 1 hour after the FOMC announcement last time. Big move up that was totally turned around within that afternoon and rejected And then, of course, following that, we then had a retest of the August lows. So that right there was that FOMC announcement last time. So just kind of keep that in mind. You don't necessarily know the market reaction in the first 5 minutes or 15 minutes even. It might take a little while to actually digest everything and see the true hands of where institutions are going, and not just traders and algorithms playing off of the momentum that is generated by the event. In terms of general chart pattern action here, you see we've had something of a bull flag pullback. Not unexpected. We've had, quite a move here. We had the stall at resistance, the stall at resistance, the stall at resistance, but now we've moved up in all the way to the prior range. And then after 2 big days, last Thursday and Friday, that we would have a little bit of a bull flag pullback, totally expected. Nothing here unusual in pullback, and that's indeed kind of what you expect when you are in a primarily bull trend, that the pullbacks are shallow and not terribly threatening, and that the bull runs are longer and more rewarding. So if this is truly going to be a bull market, these are the kinds of things that you look for. Small pullback here as it ran into resistance, small pullback as it ran into resistance, small pullback as it ran into resistance, each time powering up to the next leg. Now, of course, the next area of resistance would be the all-time highs, the top of the prior channel. That would likely be a formidable area of resistance, but that's a good distance away from the top of this bull flag pattern. We'll call that 2079. This is about, if we go up here to 39, good gosh, that must be about 50, 60 points here that we could run before we run into significant resistance. So just kind of keep that in mind. That if the FOMC announcement's truly gratifying to the bulls here, and you are caught in short positions, you could see a significant amount of hurt before this move starts to fade. And of course, I wouldn't expect that to happen in one day. Basically look at 1 times the ATR, perhaps about 20 points or so before that would start to run out of steam, at least for the day. You can look at the size of these big candles here and see those ranges. That's about the length of a typical move before it starts to run out of energy for the day. So that could give you your upper limit. The other way, of course, is to look at your option grid and see what the volatility is being priced in and what kind of move that would expect. But these kinds of binary events can really be big opportunities, or they could be very threatening to your positions. If you've got things that are really, really close to profit before the 2 p.m. release, 2 p.m. Eastern release of the Fed, you might want to go ahead and take those profits and take the risk off the table. Nothing worse than trying to make $5 more and risk 1,000 or something silly like that in front of a binary event like that. In other charts, we have the Russell. Of course, this one has been, as you heard from the morning reading, in a relative sense, much weaker than the SPX, and especially in contrast to the NASDAQ. While we talked yesterday, we don't expect that just Russell weakness by itself is going to be powerful enough to pull the big S&P down. We do watch these relationships, and when you look at the NASDAQ and it's powering up on big earnings reports, though today will likely be interesting. Let's go ahead and look at the NQ, which is the NASDAQ futures, and they're up in the aftermarket. So when you've got this kind of action on the NASDAQ, and then the other growth-oriented index, the Russell, is so much poorer, then that is something of a worrisome sign for the bulls. The NASDAQ, of course, big earnings report. There'll be a lot of talk about Apple earnings this morning, and dissection of that has big implications across multiple indices, not just Apple, but Apple is a big component of the Dow. It's a big component of the NASDAQ 100. So it's it overlays and impacts directly many different indices, and is such a huge capitalization that it also has an untoward effect, unbalanced effect on those indices. So it is a big deal about the NASDAQ and the Apple earnings especially. Okay, and then the Dow, of course, also much like the SPX, has powered through very strongly, but has had something of a bull flag pattern now. So FOMC could trump all the technical patterns that are currently present and just go in an entirely new direction as a result of new information coming into the markets. But that being said, the bias would be an expectation that we come out of this pattern at some point, maybe not today, but that we come out of this pattern at some point with a continuation move higher. Let's go ahead and get back to our volatility report. Short-term VIX is 16.31. Skew continues to remain elevated. That's been another worrisome sign. But IV percentiles continue to be very, very low. 16, or actually 15 on the S&P, 21 on the Russell, 16 on the NASDAQ, and 19 on the Dow. Nothing here to get terribly excited about. Obviously, at some point you get an expectation of a reversion to the mean and that these volatilities will spike up. But we could go very long periods of time before that happens. In terms of standard deviation moves, we had one market do that yesterday. The Russell was down by more than one standard deviation, while the other markets had less than a standard deviation price move. Somewhat less than normal amount of standard deviation moves in the last 2 trading weeks, only 3 in the last 2 trading weeks. We kind of expect normal to be about 4, though that could change today if indeed we get a big move come through. Not a promise there. Sometimes nothing happens after the FOMC and it just remains choppy, but most of the time we get some sort of resolution move one way or another, sometimes both ways. In terms of our regular daily report, we're still in phase 3, expectation of bull flags. Portfolio investor posture, IBD status, remains in confirmed uptrend. Accumulation distribution score on the S&P is a B. NASDAQ, a weaker C-, but much improved over recent weeks. GMI index actually fell a notch yesterday to a 5 out of 6, but it remains with a mechanical buy signal since 1019, though that author remains in cash, so that should be noted. Primary market condition, weak bear. When you look at the key moving average relationships, they stack up in such a way as to give you a weak bear. And indeed, when you look at decision points, you see the long term still remains as down arrows, and on the intermediate term we have mixed signals. In terms of intermediate term market posture, we're still very bullish posture with an upslope sentiment. We had that bearish cluster a few days ago. That would seem to have resolved, but we'll see also where this new information that comes into the market goes with the price action. In terms of position sizing opinions, both position sizing opinions are still at 100%, same as yesterday. Intermediate term market posture remains very bullish with the S&P, the Dow, and the NASDAQ all not just over 80 but over 90 and in very bullish conditions. Russell, though, in an intermediate term bearish market posture. Overall hedge warning status 0 plus, which is our normal with some elevated risk conditions. And some of those conditions, of course, include a market in decline and sharp increase warning that came in through our volatility metrics. Also note that both the S&P and the NASDAQ have a distribution score of a 4. At 5, those turn into warning status. The other warning area is this elevated skew, which continues to persist, and that currently is flagging about a 10-point 4% probability of a 2 standard deviation move in the next 30 days. In terms of New York Stock Exchange, new highs, new lows, pretty benign here for both bulls and the bears, 173, 187, no real signal there. Intermarket key risk aversion indicators, all 5 are flagging as risk on, though this last one is just barely so. It's pretty much wrapped around itself, and it is technically in a risk on posture, though that could very easily flip back to risk off. In terms of special opinions, no changes from yesterday. VIX is in the acceptable window for novice traders. Obviously, initiating something right in front of the FOMC is probably not a great idea for an option income strategy. If you need to make adjustments because your deltas are too high, you're not delta neutral on a strategy that's supposed to be delta neutral, you might very much want to make those adjustments prior to the FOMC announcement and be in a position that is best suited to go through potential volatility and delta move. In terms of covered call strategy, cautiously bullish. Also would probably want to initiate positions after FOMC now that you're this close to it. 1-to-1 ratio of out of the money and in the money strikes would be the opinion. Also 1-to-1 ratio of higher beta and lower beta positions. You can always, with those more aggressive setups, consider legging in through out of the money put selling. And always, always, always keep that position size in the scale you're willing to own. Put selling, similar, cautiously bullish, acceptable for new core put positions. Consider reduced position size or well out of the money puts for aggressive setups. Also consider using defined risk positions. We have still had some elevated risk factors, so things have certainly improved in recent days. But you might, with those more aggressive positions, consider reduced position size and always have that scale, the position that you are willing to own. You might want to scale in to full size on aggressive positions. In terms of sector market posture, you could see transportation showing some weakness, and this is kind of the old Dow theory that when transportation is doing poorly, it's a signal to the broader economy. Recent studies have not found that that is necessarily as true as it was in years ago. Our economy is now more technology focused on companies like Apple and Google and so forth, and so the health of UPS and FedEx and trains and truck lines and so forth don't say as much about the broad economy health as they once did, but it's another one of those tea leaves that we take a look at, and it's certainly not helpful or a good tell for the broad economy that transportation is so weak across all 3 time frames. Also energy, very difficult to be very bullish when the energy complex continues to be hurt so badly. And then of course retail has been taking quite a hit of late on the back of elevated wage cost and not having the commensurate increases in revenue to offset those significant increases in wage costs, most notably with Walmart, the largest brick and mortar retailer out there. Utilities, this is likely posturing in front of an interest rate decision. Remember, utilities are very sensitive to interest rates. Their investment value is largely derived from what's thought to be their dividend return on yield, and also these companies often have very high debt loads, issue a lot of bonds, and so they are also sensitive to interest rate changes. In terms of sector percent change, you see mostly negative with energy at the bottom, though healthcare did put in a big day, and this was actually driven by IBB, the biotech sector. We've been talking a fair amount about IBB, and an important breakthrough yesterday, breaking through the horizontal support in a very, very strong way. Good candle, not just poking its head, but closing well above this support. Obviously, we'll have earnings reports, Gilead and others that'll be coming in that'll be influencing this price action today and in the days to come. But now that this has, we had a 30% pullback, basically starting with the Hillary tweets and others attacking this industry segment, and that seems to have found some sort of bottoming pattern. And hopefully we'll be able to come back up here and make a run at this 365 area. Now, keep in mind that it also bottomed here. This is your August 24th low. Bottomed here, had a nice build, and was recovering. And then, of course, the political stuff started coming in and heating up again, and took this down to this level. So the question is this just a complex wedge pattern and then continues to the downside, or is this more of a bottoming pattern and the pullback or correction actually, this is more than 20%, it's about 30%. The correction here is over, and then we now look for this to start retaining back some of these former prices, and we start to see this backfill. So very interesting action here, but that's very much what's going on in healthcare at this time. So let's see. I think that's probably enough for today. Went a bit long, but hopefully you found that the information was extremely useful. If you did find it useful to your trading, you can show that appreciation by liking us on YouTube, subscribing to the YouTube channel. That gives you a heads up when the videos have been posted. And then, of course, retweeting us to your Twitter followers, to your StockTwit followers. All those are great ways to show appreciation for what we are providing to you in this market preview each morning. If you have direct commentary, you can send comments to support at falconglobaltraders.com. Other opportunities available. The website here will give you more details. Also, this website, more details about what we do at Falcon. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.